You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. Starting out today, as I normally do, directing your attention at an entire plethora of information for you to tap into in personal finance that is located at the website known as wealthformula.com. So make sure to go ahead and check that out. You can get free books, free downloads, all sorts of stuff. Make sure to sign up for our lists and, get involved. The other thing, as it relates to getting involved, is consider joining Wealth Formula Network. Wealth Formula Network is our inner community. It is the community in which you take it to the next level in your investing journey. It starts out with a course. The course is taught by some of the smartest people around in this area of alternative, as they say, investing, including the likes of Ken McElroy, Tom Wheelwright, Real Estate Guys. We got Kevin Day in there. We got Christian Allen. We got a bunch of smart people. And then after that, it doesn't stop. It's the gift that keeps on giving. It is a bi-weekly mastermind call that we do on Zoom. We get to look at each other. And we also have a Facebook group. Anyway, those who are part of it, who are part of Wealth Formula Network, I believe are getting the absolute best bang for their money there is possibly out there in this space in terms of masterminds. This is dirt cheap compared to everything else I've joined. So check it out, wealthformularoadmap.com. Would love to have you join our little community. And as far as today's show goes, so we're going to be talking a little bit about Centimillionaire stuff with Richard Wilson. But before we do that, I've been getting a lot of questions from investors lately on how to choose investments. And it's a really good question. It's sort of a nebulous answer, unfortunately, because how do you even begin to describe the process, particularly in private placements that these opportunities are readily available to accredited investors. And once you get on people's lists and stuff, you get bombarded by them. So I'm going to attempt to try to address that question. And first, before we begin that, though, I want to be clear that there's no magic solution or process to get all of your investment picks right. In fact, if you invest long enough, something will go wrong. And it reminds me, of a surgeon. A couple surgeons that I remember talking about this when I was a resident, saying, if you haven't had a complication, you haven't done enough cases. Well, yeah, I found that out too, and during my career. And it's, it's what it is. It's a process, right? I mean, you're going to have things that hopefully you get to a point where you win most of the time, and once in a while you have a surprise loser, and that's kind of where you want to get. So there's no magic to this. But the next thing I'll say is that as I continue to explain my process, that none of this should be construed as investment advice, because all I can do is share my experience. Because after all, it is experience that has, for me at least, paid off the most. I started looking into the private placement space in general probably about 7 or 8 years ago, and primarily as a passive investor. And it was something I've real estate in particular was something that I knew I wanted to get involved with on the passive side as well, and Ken McElroy was involved. So that was a no-brainer for me. And, getting to know him over the years, that has proved to be a very good sort of baseline for me. But, there's others out there. There are others out there, as you know. I tend to work with a group called Western Wealth Capital a lot. That Ken is good friends with Dave, and that process was a significant one for me to get through. But the bottom line is that the trouble people have is because there really is no roadmap to follow when you sort of take investing into your own hands. That's why, by the way, my course and everything is called Your Roadmap to Real Wealth, because this stemmed out of this whole place where you're like, gosh, I really like this alternative space. I like this idea of empowerment. Now what? Well, that's, wealthformularoadmap.com. That's where you start. So anyway, so where do you start when you're new at this stuff, right? And well, unfortunately, I started the wrong way in some respects because I started looking for people, which was not a bad instinct because I think that's where you want to look. You want to look for people, but where did I look? So I looked on Google, ended up finding a guy who's a bit of a charlatan in the space. He's on a lot of podcasts. He's on YouTube a lot. He gets himself on. He calls himself a hedge fund manager. So that sounded like a great idea to me, given his background, to contact him. And so I spoke to him, and he was really good at making me feel like I was a smart guy and somebody he'd like to work with. So he suggested, well, hey, why don't you join my team? Because it sounds like you have some real estate experience on top of, everything else you do. And so, I thought, hey, why not? That sounds like a good idea. I'd get to participate as a limited partner, but I'd also be on the general partner side and be able to leverage some of that as well. And I thought, well, in the process, I'd learn something about being a fund manager, because this guy says he's a fancy hedge fund manager. He told me that like 3 times. So anyway, I signed up, and so that was probably 6-7 years ago, and pretty quickly thereafter, I was listening to these weekly, he called them, they were investor calls, and we'd be basically talking to some guys in Austin about some development and stuff that was going on down there. But what I found in short order is that there was multiple people on that call, and that, as it turned out, it was almost sort of like this scheme where he'd bring on these people who he thought would be able to raise capital for him because of their friends or their community or whatever. In my case, because I was a doctor, and but there was a number of people on that call or in that team that had a similar background, and one similar background, which was that they all had a circle of friends or community that had money. So it was sort of this little scheme where he would say, I'll partner with you. You can kind of come on board and you raise money. And again, I was tagged as a guy who could bring in money for doctors. Okay. So that in of itself is not necessarily a bad thing, right? I mean, raising capital, fees and stuff are not, it's part of the game, right? It's part of like the reality. I mean, if you invest with people who are going to do work, they have to get paid. So that should not be a surprise. And in fact, if you yourself got in this position and you could bring people to great opportunities and get some additional benefit for yourself, well, that's great. There's nothing to be ashamed of. That's a good thing. You are solving a problem that people have, and man, do they have it. Listen, that's why we're doing these podcasts, right? But in the process, you're helping others. Now, that all was great. Now, here, though, was the unfavorable part of this whole fund structure that there was. All these team meetings, that there was, it was always very clear that this self-proclaimed hedge fund manager had very little interest really in making investors money at all. And every conversation I attended was about fees we could charge, which ultimately he just kept for himself anyway, and the need for us partners, quote unquote partners, to bring in more money for him. And he urged me on countless times to put together a group of doctors for him to speak with, and even get my dad involved, who had some, a little bit of money. Luckily, I didn't do it, and I didn't do it. It was pretty clear to me that this guy was a shyster, and I should distance myself from him as soon as possible. So in the end, the money I invested as a limited partner was lost. I resigned from the GP side, said I didn't want to be part of it. For the past 6 or 7 years, I've been receiving those limited partner distributions, which has, as I suspected at the time, been limited to $0. And meanwhile, I know that in the process of this, I know this guy, because he bragged about it so much, made a ton of money up front and really doesn't care about losing investor money in the least. And I see this guy still on podcasts and YouTube and stuff like that. It drives me nuts. And this latest thing he's talking about is opportunity zones. And he's been jumping up and down the greatest thing of all time, blah, blah, blah. And it's just, gosh, just stay away. right? So anyway, so I made a mistake here, though. Well, and what was that mistake? Well, I looked this guy up. I looked for what is it that I looked for him? Well, he was a guy who was on Google, who seemed to know what he was talking about. He was a guy who made the podcast circuit and kind of used big words to make himself sound impressive. He was and is a great salesman. And at the time, I made a mistake that a lot of people make, which is I mistook someone who's a great salesman for someone who is a good fiduciary for my money. And you might think that is an uncommon mistake. Think again. Now think about it seriously, because I know when people come up to me and they talk about, what have you heard about such and such? What have you heard about such and such? Most of the time, it's because these individuals are prominent on social media or they were heard in a podcasting circle. I'm not saying that they're all crooked like this guy. It's just that they've not really necessarily proven anything to you other than that they are good at getting your attention. So if not Google and social media, where do you start? Well, let me go back to, again, my approach, which in this age of the internet and social media is a little bit archaic. It's a little bit mundane. But I start with something very simple, which is positive feedback from other people I know who've invested with groups who've actually had good experiences. And then I go back and I investigate into them. So I mentioned one of the operators that I work with a lot is Western Wealth Capital, and I work with them on a regular basis. They didn't find me. I didn't find them on a podcast circle. I found them through some investors in our group that told me about their experience and the kinds of returns they were seeing over time. And that's really what got me interested in the first place. And so I was like, wow, well, that's great. I mean, that's completely unsolicited. These guys obviously have nothing to do with this business themselves. They're just saying, hey, have you heard about this? I'm getting great returns. These guys are amazing. I love these guys. So you start with that. That's a good place to start, right? Rather than Google, rather than social media. With these guys, the next thing I did was some good old-fashioned reconnaissance. So I talked to several different people on their team. I talked to several investors. I tracked the ongoing sentiment of the known investors of theirs that I knew about over a year, made a trip out to walk properties with them, met with them in person, looked them in the eye, which it may seem again archaic, but I will tell you this, that as some of you know out there, I have a pretty good instinct sometimes about sort of bad players. I think I developed it a little bit since obviously being that silly guy who partnered with the initial guy first, but I've been pretty good about dodging full out criminals. But with these guys, I just had just this great feeling. And then I got a stellar reference from Ken McElroy, right? For somebody with tremendous integrity, who I've gotten to know and really have a tremendous amount of respect for. And so that was kind of the extent of the social due diligence. Now, you may have not heard that term before because I kind of just, I feel like I just kind of made it up. But social due diligence, what I'm talking about there is, all right, so you learned about some group somewhere, and hopefully it wasn't on Facebook, and hopefully it wasn't on social media, or about some book with a name that suggests that you too can become a millionaire. And then you try to figure out what the experience of others around you who that you know and like and trust are, and then once you get through all of that, then you've kind of completed your social due diligence. You met with the people, you've talked to them, you think that you trust them, you don't get the heebie-jeebies when you talk to them, and so at this point with the Western Wealth guys, I felt very comfortable moving forward, and then at that point began to look at the numbers and focused even more on that track record. Notice how the numbers really became secondary at the end of the process, not at the beginning. Because at the end of the day, I invest with people. I invest in people. I don't invest necessarily in projects, because projects look great and anybody can make a project look good on paper. In fact, I can honestly say that the glossier and fancier the offering memorandum, the less I will necessarily trust it right off the bat, because I want to know the people and know the numbers in that order. I don't need to be impressed by fancy graphics, etc. Of course, not everyone has the time to do this kind of vetting, and that's why we have our group, our Accredited Investor Club, which you can sign up for on investor at wealthformula.com. If you are, if you make $200,000 a year, $300,000 filing jointly, or have a net worth of $1 million outside of your personal residence. Now, again, as an aside, at the end of the day, the answer to the question of how do you find good people, how to find a good investment is you find good operators, you find good people. And that's why I don't work with more than a handful of them. First of all, it's exhausting to find the right ones. And when you do, what's the point of jumping all over the place? The wealthiest people in the world, the most successful people get there through specialization and focus. They don't go jumping from one shiny object to the next. They see something that works. They see a track record. They just hit it over and over and over again. So that is the philosophy that I ascribe to as well. So, look at Warren Buffett. That's basically his philosophy too. Anyway, my guest on this week's Wealth Formula podcast can attest to what I'm saying, because he's been around some of the wealthiest Americans in the country and has learned the secret sauce behind their success and the way they think. His name's Richard Wilson, and he is the founder of Family Office Club. If you want to learn to think like the rich, you've got to kind of get in their heads and think the way they do. And there's no one better to tell you how to do that than Richard Wilson, as he's the guy who works with a bunch of centimillionaires all the time. And when we come back, we will talk to him on the show. Welcome back to the show, everyone. Today, my guest on Wealth Formula podcast is Richard Wilson. Richard helps $100 million plus families in terms of net worth create and manage their single-family houses, and currently manages 14 clients, including 3 billionaire families. He's also the CEO of a $500 million plus single-family office and head of direct investments for another family with over $200 million in assets. Richard is also the author of the #1 best-selling book in the family office industry, The Single Family Office, Creating, Operating, and Managing the Investments of a Single Family Office, and recently released a book called How to Start a Family Office, Blueprints for Setting Up Your Single Family Office. Richard, welcome back to Wealth Formula Podcast.
Yeah, thanks for having me on here, Buck.
So, you were on before, but I do want to kind of review some of the things because it's been a while. It's been over a year, and I'm sure a lot of listeners are new. How did you, just give us a little sort of review on how you got into the space in the first place, right? It's a pretty unique thing to be doing. And just looking at your bio, your bio included like an LLM in psychology, or no, not an LLM, a master's degree in psychology or something like that. And I'm thinking, wow, how did you go from there to that position?
Right. Well, I had already been working in capital markets, and I took the psychology courses to try to figure out how to effectively communicate better. Yeah. And how to position myself better. So my classes were full of psychiatrists and psychologists, and I was the one person who was there to kind of learn the stuff to put it to use in the business world and in the investment world. And then around that same time, I found this concept of family offices was taking off, and that was in 2007. And I was in the right place at the right time, and then just put a lot of focused energy over the last 12 years and really sharing the journey. Every time I learned something, I'd share it online, I'd share it on stage somewhere, I'd share it on a podcast like this. And the more that I give away, different insights I get from meeting with family offices, the more that family offices reach out and they want help with something such as setting up their family office.
Sure. Absolutely. And, so before we get sort of into the nuts and bolts of the family office itself, I'm just still curious because you're in a unique position, to see where the wealthiest people in the world really made their money in the first place. And I'm specifically interested in not those that necessarily have inherited their money over generations, but some of the people who are coming in, say in the last decade or two, What are the most common sources of the wealth that you're seeing?
A lot of times manufacturing or high-tech companies where they've had an exit. When there's a lot of M&A, then there's a lot of liquidity events.
Right.
So high intellectual property companies. Manufacturing is a surprisingly high number compared to, you don't hear about it in society much. You don't Shark Tank, you don't see a lot of manufacturing companies going up there, right? So these might be companies that have been around for 30 years. It might be seen as kind of a dirty or a niche business making zippers or little metal fasteners, et cetera. But somebody might have an exit there for $80 million, in an area that, by society is not seen often. So I think people forget about the number of manufacturing families out there. And then like in your space, I know you do a lot of work in commercial real estate. There's a good percentage of families that come from that world, and they've made their money through real estate development, and they're still doing so, but it's spinning off enough cash, and they've created such a net worth, they also need a family office around their activities.
Right. So it's pretty interesting that, I think the idea of the sort of the boring business being surprisingly profitable is something that I see often, right? I mean, it's not really the sexiest stuff that necessarily becomes the most profitable. I have a friend whose father started out as he was a janitor and then built one of the largest janitorial companies in the country.
Wow.
Is just phenomenal. But yeah, and he passed away, but he'd tell people he cleaned toilets for a living. And the guy was just like, north of 100 million easy.
Right.
So, but that was what he used to tell people. So the next question might seem a little odd, and it may be related to the first one, but also, again, you have a psychology degree, and when I think about the types of people you're dealing with and the types that are here, which is, a lot of really smart people, probably the kids who finished, at the top of their class, and, a lot of these centimillionaires weren't even close. Is there a fundamental difference in the mindset of the ultra wealthy compared to, say, the rest of us, highly educated, working slugs who are doing fine, but at the end of the day, we're not anywhere near that level of wealth?
Yeah, I do think there's a mindset of focus and going all in on a strategy. Nobody became ultra wealthy by diversifying their energy into 10 projects and diversifying their investments into 50 uncorrelated assets. You don't become ultra wealthy doing that. So like Warren Buffett, having a few eggs in your basket and watching them very carefully. It's not a recommendation for somebody's total investment portfolio, but if you want part of your portfolio to create wealth for you, you can't diversify into 200 things and expect your net worth to jump from 1 million to 20 million. In my experience, it's just not likely to happen. So I think having a focus on something and also having a unique game that they're playing. So perhaps globally or in their industry or at least regionally, perhaps they're developing a unique game to play that nobody else is playing that same game or has that same type of focus, or they're keeping score a different way, or their business operates in a different way, and it makes it hard for competitors to react to that. And I think that many of them have kind of changed how their industry works by the unique game that they invented to play in their space.
Interesting. So let's kind of jump back into, the family office idea itself. So the family office is, it's sort of technical terminology, right? I mean, what exactly is a family office, and what are the components that make it up?
Sure. Well, there's two types, and in both cases, you're trying to create a more holistic solution for the investor. So things are managed for them as much as they want it to be. Things are done more holistically, and it's not all in the brain of the individual. Most high net worth individuals, they have to remember what their CPA said, what their insurance agent recommended, what their wealth advisor said, and keep track of all this. But when you become ultra wealthy, you have way more going on, a lot more people trying to meet with you, a lot more things on your plate, maybe 50 LLCs you're involved with in some way, a lot of investments. So there's more chaos. You're more likely to drop a ball, and every dropped ball might cost you enough that you could have hired a full-time person to help you. Yeah. So a $50,000 mistake here, a $300,000 overpay in taxes because you sold 1 week late on an asset there, lack of trust and estate planning could cost you millions. So having a holistic solution is important. And the two types of family offices, there's a single family office that if you are worth 30 to 50 million or 100 million plus, you might want to consider having a single family office in place. So it's a team dedicated just to helping you and your family alone, where a multifamily office is like a more holistic wealth management firm. And they might have 10 or 20 or 100 clients that are all worth, 10 million, 20 million plus. And it's just a more holistic, long-term minded wealth management firm that's really equipped to work with the ultra wealthy, because there's a different level of challenges and headaches that come with the wealth.
So we certainly have, a fair number of people I know who listen to the show who are, over the 10 million net worth mark. Is that typically what you're talking about in terms of, is it usually, liquid assets that you're talking about though, when you're talking about those different levels?
Liquid or becoming liquid. It could be assets that might be turned over every 5 to 7 years because it's in a real estate asset, or it could be locked within a company that you're going to sell, but maybe if you're a high income earner, you can still be taken on as a client of one of those if you're earning $1 million plus a year, but you know that your practice might be worth 5 or 10 or $20 million, et cetera. You might be able to get a family office to take you on as a client. But typically, or some of the multifamily offices will have a bare minimum of 10 million liquid assets or 25 million investable assets. It just depends on the multifamily office and what their minimums are.
Right. And does it, at what point, I guess, would it make sense for somebody? Because I think when you talk about, somebody who's making 7 figures per year, it's over $1 million per year, has a net worth of 5 to 10 million or 10 million or whatever. For them, I mean, if they are high income earners and they're not necessarily business people, but they have a lot of like investments they're doing, et cetera, what is the real value to them as opposed to necessarily just having, a really good, CPA, a really good estate attorney? I mean, is there what, I guess the question is for the lower tier of people, which I think probably some of the, certainly I hate to call them lower tier because they're doing pretty darn well in our group.
Sure.
But what's a good sort of reason to join if you feel like, well, gosh, I've got a good CPA, I've got a good estate planning or asset protection attorney. Is there additional value that you can gain, through a family office just by being part of a group or this entire, group of significant amounts of money?
Yeah, for sure. There's many benefits of it. So if you love your CPA or if you love your estate planner, usually people only really like one of their solution providers, if any, and that's why they feel like they need to come figure out their family office solution. But let's say you like both your estate planner and your CPA, then the benefit would be that you can have a multifamily office helping coordinate with the CPA, with the estate planner, being a second opinion on what trust should be set up when you're purchasing an apartment building or transacting through an independent sponsor, what capital should come from what trust to go with the estate planning that the multifamily office with the estate planner helped overlook and design. They could help you with philanthropy. They could help you with tax optimization. A lot of CPAs who are excellent, they might have done your bookkeeping for 20 years and helped you sell your practice or your business, et cetera, don't do a lot of tax planning going forward. They might not help you plan for the next transaction, how to structure that. They might not plan or look at every part of your portfolio. And the issue is that a lot of CPAs and accounting firms, it's a relatively commoditized service or solution many times. So they have to have 200 clients to be successful or 400 clients as a firm. So it's very hard to get to know individual clients and spend a lot of time on them because a lot of them are priced to serve the mass affluent and the lower, the $1 to $3 million net worth individuals. And with a multifamily office, they'll take the time to get to know you, your goals, your children, the second generation coming, what you plan to do, and help you set up those vehicles to be tax efficient moving through this new reality that you want to live in now that you're ultra wealthy. So reduction of chaos, better management of all the moving parts, and typically the tax savings and estate planning savings alone will pay for the cost of setting up and establishing and paying for the family office for several years to come.
So what are those kinds of costs? I mean, say we're, again, talking about some individuals in this group may fit, the description of 7 figures and 10 million.
Mm-hmm.
What kind of costs of setup typically and ongoing fees, would you typically be looking at in this scenario, or does it sort of depend on, the complexity and all that?
The spectrum, where you are on the spectrum, depends on the complexity, but it might start, as high as 1% or 1.25% of your assets, and it could go as low as 30 to 50 basis points. If you're at the high end of net worth, then you'll get charged less for how much you're worth. But importantly, it could be that you have a private jet, but you're not documenting the business use versus personal. You could get dinged on that pretty hard during an audit that will almost inevitably come. It could be that the estate planning has not been done right or updated as laws changed. So you might lose millions of dollars if there's a death in the family, et cetera. And many times individuals are using retail custody and retail wealth management solutions, and they're paying double, triple what they should be on their custodian accounts and their trading and their investment management work, et cetera.
Is there advantages to people within these family offices in investment opportunities? For example, or do you tend to get better terms than the typical mom and pop accredited investor if you're looking at a private placement?
Some people set up a family office and they still don't negotiate hard on terms or think too creatively. But if you are doing direct investments, you should look for a multifamily office that's really specialized in helping you do that. And most multifamily offices are not equipped to do that. It's a really small minority. And that's something I think is going to change in the industry, but is one of my biggest complaints about it right at this point. And at our firm at Centimillionaire Advisors, we find that family offices who are most successful in setting up their direct investment programs look at their portfolio in 3 compartments. They look at their defensive compartment, which is traditional wealth management, high diversification, getting into uncorrelated assets, et cetera, and it's just plain pure defense and your arm's length away. An advisor is doing that for you typically. Then we find that through using independent sponsors, maybe a real estate fund manager, maybe direct to a couple properties, but usually through an independent sponsor, you have the second compartment of cash flowing commercial real estate where it's hard asset, it's tangible, usually local or semi-local, and in 1 or 2 asset classes you're comfortable with, like self-storage and multifamily, or data centers and multifamily, et cetera. And the third compartment is usually direct investments into operating businesses where it's where you created your wealth, in manufacturing zippers or in cosmetic surgery, et cetera. And that's where you play the most offense and you have the most control. You're not relying upon sponsors. You're not having a wealth advisor do that for you. You're investing in cosmetic surgeon practices or in technology or IP related to it. So when you separate things into those 3 buckets, it allows you to look at yourself, your goals, your risk preferences, your time horizon, and look at potential people that you're going to add to your family office team or potential multifamily offices and say, is this group equipped to help me? And if they are, in which bucket are they going to be helping? Are they just the defensive portion? Now I need to go and find and figure out my cash flowing commercial real estate portion, et cetera.
Right. So, it's interesting that what you say about those buckets, because, when you hear buckets from typical financial advisors, those buckets are full of different things. Like, a doctor or lawyer, mid six figure person or whatever, going to a portfolio manager. The first thing they tell them is, well, we need a diversified portfolio of stocks, bonds, and mutual funds. Which of course is never going to make you ultra wealthy, right? What can a person learn from the way centimillionaires invest their money?
Yeah, so I think that many times people hear their whole lives, anything related to wealth is about diversification. Just play it safe, ultimate defensive strategy, and that's what everyone beats the drum on in the whole industry. And I think with direct investments, it can be diversification. If you're investing in data centers, mobile home parks, self-storage, and multifamily and office parks, and you're doing that in Singapore, San Diego, Brazil, and Mexico, or even 5 different cities in the US, you're in so many asset classes and so many geographies, there's no way to be an expert or even know the base facts about what's going on. Even if you manage $3 billion, you're not going to be excellent at doing those things.
Right.
So there's a place in a portfolio to play defense, and there's a place to have a moderate approach and a place to play offense. But with direct investments, if you looked at 50 stem cell investments or 50 surgical centers or 50 self-storage properties, by the 50th one, you're going to be able to tell a good apple from a bad apple on a relative sense. Even if you didn't know anything about the space before, hopefully you do, or you have someone advising you. But just that focus will allow you to make better direct investments, get better deal flow. People will know what deal flow to send you. You'll know what's normal, what's typical, what looks more credible than usual, what's better priced than usual. And you'll find specialist service providers to help you get a third-party valuation or manage a property or manage a business, et cetera. You lose all of that when you try to diversify your direct investments, especially in an extreme way. So I think that centimillionaires and family offices in general, when it comes to direct investments, they need to choose one or two types of commercial real estate, constrict geography to the degree that makes sense for the risk level that's appropriate for them, and then look at the direct investments they're doing in operating businesses and be focused there as well, and not diversify direct investments too much, or you lose all the learning curves that gives you any sort of advantage in the marketplace.
How much do you see actually invested within publicly traded markets for these centimillionaires? I mean, are people also? I mean, do they buy ETFs? I mean, do they do that kind of thing, or is that kind of just very pedestrian for them?
Sure. So a lot of private banks and multifamily offices they hire will buy ETFs for them. Most of them aren't trading those internally themselves. But I had breakfast with a $300 million family a few weeks ago, and because they created their wealth in the public markets, they're all about that, and they control that internally. They're the exception. If you made your money in commodities or running a hedge fund, then of course you're the stranger family office who keeps that all in-house and has their own thoughts about how to do that. That's your backyard. But the average family office is outsourcing that part. And honestly, they almost always should be outsourcing that and only doing the things internally they're excellent at. So the takeaway for someone listening to this perhaps then is also, if your whole career you've been a dentist and managing a chain of dental clinics, or if you're running a business of some type and then you sell it, unless your huge passion is now stem cells or now the stock market or ETFs, probably should leave that to a best-in-class expert. Look at your DNA, your background, where there's opportunities, where there's momentum, where your passion is, what you're naturally excellent at, and combine those things and find the crossover so that your energy is invested where you get the most power per hour out of that, instead of doing your own bookkeeping, instead of figuring out your own estate planning, which would be crazy to try to do, et cetera. You should focus on what your unique abilities and what your strengths are and pour your energy into that.
Out of curiosity, I have been somewhat interested in the world of digital currencies, and been sort of following the movement on institutional involvement, family offices. There's some pension funds involved now, believe it or not.
Mm-hmm.
Are you seeing any family office interest in things like digital currencies like Bitcoin?
Yeah, for sure. I mean, both in Bitcoin and just blockchain in general, I think there's an interest. I think some families don't know what to make of it, but they put it in that bucket of maybe a couple % of their assets, and they say, well, it's either going to go from X to zero, or it's going to go up 50 times or 100 times long term as countries' currencies keep failing every 7 years on average, and they start adopting the use of using Bitcoin via their mobile phone or some other crypto asset, et cetera. So I think some of them take a little bit of a flyer on it because the upside is much, much higher than the potential downside. Yep. But a lot of them, if they didn't make their money in technology, or they didn't make their money in some related space related to high-tech IP, and a lot of them don't understand it enough to make like a big investment into the space, I've found.
But I think what seems to be interesting to people about this space that even don't know about is they understand there is a significant asymmetric risk profile, which, as you said, 1 or 2% goes in. Okay, if you don't understand it and you think there's a possibility this goes to zero, it doesn't hurt you as much as it potentially could help if it goes 1,000x.
Right. If it becomes true mainstream. I know there's 7 years ago, you were strange if you even talked about it. And then it got up to $1,000 per coin, and then 5,000. It jumped up to 20,000, and everyone felt like, oh my gosh, it went mainstream and now it's too expensive. And obviously with the Bitcoin price, at least it's come back down a little bit. But long term, if it truly became globally kind of a mainstream global currency, then that's the scenario that people are putting a little bit of money in to prepare for.
Yeah, I can imagine, especially when you've got the likes of Fidelity and some of these other companies that are coming along, getting involved. That's probably getting people more interested. Well, tell us about your podcast and why you started it. Who is it for? What value? I mean, is there value for people who are I guess maybe not centimillionaires in there as well?
Sure. Yeah, it's just called the Family Office Podcast. And every Thursday, we're releasing some conference content because we host 25 events per year. And we'll put a discussion panel on commercial real estate, or a discussion panel on how to raise capital from family offices, or a discussion panel on how to set up a family office, et cetera. And we'll have 5 experts on stage at our events talking about it. And we'll rip the audio from that and put it out on the podcast every Thursday. And then on Mondays, I talk about what my clients are looking for, what's happening internally. It's just a 1 or 2 minute update on the Family Office Club and Centimillionaire advisors, and just talking about what our clients are seeking investment mandate wise. And then we'll put other little insight videos out there. So I think anyone who's looking at putting together their own family office solution, or thinking they might want to engage with a multifamily office and figure out how they should navigate the space, would benefit from potentially listening to that. And it's because of feedback from the podcast and the events that we just recently released this new book called Centimillionaire Migraines. And I'm reminded of it by your question, because the podcast, as I'm sure you've found, has been a great way to get people to reach out cold to you. Sure. And it's through all of the connections from the events, the podcasts, the books, et cetera, they've been able to see that almost all of the ultra wealthy, really starting at 30 to 50 million, there's no word for 30 millionaire. Otherwise, we would have called it 30 millionaire migraines. Right. But it's called Centimillionaire migraines because at that level, it's inevitable that you have these headaches. But they really start at 25, 30 million. And the same 6 headaches just keep coming up again and again with our clients. And a couple of them, they don't cost any money to solve. They're really just approaches like mental awareness, intentionality that need to be integrated into what you're doing.
Absolutely. So where else can we learn about what your work, get a hold of you if appropriate, et cetera? We'll put it in the show notes as well, but why don't you let us know?
Sure. There's just 3 quick places in 30 seconds I could rattle off. If you're just getting introduced to the family office industry and you want to learn more, we have our event schedule, our membership, a free book on family offices, all at familyoffices.com. If you're listening to this because you're raising capital and you're trying to figure out the family office industry for that purpose, we have capitalraising.com, and we've got an 80-page book you can download there in PDF format that gives my 5-step system for raising capital away for free. And then the last resource is if you're ultra wealthy, you've had a liquidity event, or you're a high 7-figure per year income earner and you want to figure out a family office solution for yourself, then our latest book and a whole data room of free resources can be downloaded for free at centimillionaires.com.
Again, we will put those in the show notes as well. Richard, thanks so much for being on Wealth Formula Podcast again.
Awesome. Thanks for having me here, Buck. Appreciate it.
We'll be right back. Welcome back to the show, everyone. Hopefully you enjoy that. Richard is always a gracious guest, and it's always fun to have him on. I do want to point out we're going to have an upcoming Ask Buck show, so make sure to go to wealthformula.com. Leave me a voicemail question there or a comment, whatever you want. Make it a good one. And leave as much or as little information about yourself as possible, or not as possible, but as much as you want me to reveal about you, because we'll just play whatever you record. Would love for you to get involved again with wealthformula.com and just go to the leave Buck a voicemail tab there. Also, I want to urge those of you to consider joining Wealth Formula Network again. I do think it's a great place for people who want to take it to the next level and have a community of like-minded thinkers. Check that out at wealthformularoadmap.com. Finally, when you go to wealthformula.com, make sure to give us a 5-star review, because we need these reviews. We need subscriptions, et cetera, to keep our higher ranking so that we have a continued flow of really quality guests like Richard Wilson. Anyway, that's it for me this week. This is Buck Joffrey with Wealth Formula Podcast signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions not fact. As always, consult your own financial team before making any investment. See you next time.